Here in this video, we will be going over everything that happened in the markets today, what to be watching out for, and what Tom Lee just said on X. Tom Lee just shared this post that says, harmonized core CPI inflation from the BLS and harmonized core PCE inflation, Moody's estimate, harmonized inflation, which excludes owner's equivalent rent, is the best measure of underlying inflation and what the Fed should be focused on. And you can see, if you look at harmonized core PCE and harmonized core CPI, you're actually under the Fed's 2% target. So it's really just a matter of time before the data actually reflects the reality of inflation. Yes, prices are high, and prices are probably never going back down. Not too often you see deflation, but I mean, you're already at 2% inflation. In the second half of this year, as Tom Lee, Fundstrat, believes, you will continue to see disinflation, and that will fuel the markets move higher. Now, I want to be honest, I'm not bullish on the S&P or the NASDAQ on a headline basis because I think it's fully valued. I think valuations are rich. I think small caps and interest rate sensitive stocks that Tom Lee and Fundstrat also believe will outperform, is by far the best area of the markets to be in. Especially if that $6.3 trillion of money that's currently in money market funds does come back into our markets. I think a lot of that money is going to go into your interest rate sensitive stocks. They don't have to be small caps. Interest rate sensitive stocks would include Tesla and PayPal and some of these companies that are large companies, but also deemed interest rate sensitive. I actually think that's probably a better place to be, not quite your super small caps, because if you still want some quality, you can do PayPal. You can get some Tesla, you can get some Square, you can get even to some degree like a Dollar General should benefit if rates go lower and people start spending more money again. Now today we did get a little bit of bad news. We did get the CB leading index. And month over month, this came in at negative 0.6%. The estimate was negative 0.2%. Last month was negative 0.3%. So we were actually expecting this would get less negative. It actually got a lot more negative, about 3x worse than expectations. That's not great. That's the LEI. That's the leading economic index. And it always has in the past led to a recession when you've been this negative for this long. You've been negative now for 26 months. And if we are going to see any kind of material downside for stocks at this point, it's probably due to the economy weakening more than expectations. Now take a listen to what JP Morgan just said about markets, specifically the S&P 500, and what you need to be watching out for if we hit this level, stocks could fall a lot more, according to JP Morgan.
Technical strategy Jason Hunter warns this could mark the terminal phase for the bull run. Joins me now to make that case. Good to see you again. The terminal phase, why isn't this confirming that the next leg is upon us?
Well, if you look at the rebound we've had from the 49.80, 5,000 target zone, that was our initial target zone when you saw that March, April short-term top build. The market's rallied from that, and clearly it's carried inertia again. These new highs aren't being confirmed by momentum. So what we think we're seeing potentially is, starting in March, April, that deceleration, the pullback, and now another push to a new high. If the market can't sustain these highs, and right on top of next resistance at 53.20 to 53.50, we suspect the market will stall out there. A pullback that then breaks the 50-day average again. We think you have to take that very seriously. Ultimately, the entire first half of the year, this price action we're seeing, let's call it a range between 5,000 and 5,300, may turn out to be a distribution pattern. It's hard to have a lot of conviction in that until we see the price action develop and the failure from the new high. But that would set what technicians call momentum divergences on the lower frequency charts, the weekly time frames, the monthly time frames that are already in place. That would set those signals, given the curve inversion, historically, that tends to mark the terminal phase, like we said in our note earlier this week.
I know, but there's like a lot of potential. A maybe. I mean, I'm wondering why wouldn't the market be able to sustain this move? There's a lot of suggestion that it won't be able to handle that. Why?
Well, so, again, taking a big step back, looking at the cross-market contextual data, the yield curve, 3-month, 5-year curve has been inverted now for 18 months. If you go back to the 1960s, leave out the period of 1970s when the monetary policy was so volatile, the equity market just followed the yield curve. If you look at the 1960s and the post-1980 world, it was roughly an 11 to 23-month lag between curve inversion and equity market peak before you got a bear market that was associated with a recession. Like I said, we're at 18 months in now, right inside that window. So that's where you start to look for, problem areas. Like I said, we're not aggressively saying go short the market right now. In fact, on a near-term basis, tactically, until we see that deceleration, as long as the S&P is above 5150, where it broke out from earlier this month, it still carries bullish momentum with it. We're not saying aggressively go short, but if you do see that reversal unfold and then you get a break below the 50-day average, that's something I think you need to take very seriously given where we are in the cycle.
I understand, but if we obsessed over the inverted yield curve for the past 18 months, we would have missed the entire bull market. We would have missed the entire thing because we've had an inverted yield curve for that long, and all we have talked about is whenever you have a inverted yield curve, got to watch out. Going to have a recession. Don't be too bullish. And we've taken out these higher levels, and we're still talking about an inverted yield curve.
Yeah, so it's not the entire 18 month isn't the window. Like I said, it's once you cross the 11 month in, and if you look at that iteration when 11 months was ahead of the market peak, that was the COVID recession. So I think you could take that away. It's really 15 months to 23 months if you look at the bulk of the recessions in that time window. Now that we're at 18 months, you're now in that window. It wasn't the entire period that you look at the yield curve and say, a second you go inverted, you get bearish. That's not the case. But like I said, it's now you've had monetary policy in restrictive territory for quite a while, and the pattern's the pattern. Historically, when you get in this window, that's when you tend to see equity markets decelerate, form distribution patterns, and roll over.
I understand, but again, I think it's important to point out, I'll give people the fact that you don't have a recession without an inverted yield curve. But an inverted yield curve doesn't always mean you're going to have a recession, right? It doesn't. There's not one and the same. So
to the extent,
you could have an inverted yield curve for a long period of time and not have a recession. That's why this time, for a variety of reasons, I know that you get killed for saying stuff like this, that it actually could be different.
Sure, it could. And if you look, the 2 times you've had the 3-month, 5-year curve even marginally inverted without a recession was the mid-1960s had an iteration where the curve barely got inverted and then immediately started to move in the other direction because the Fed eased aggressively. And the other time was the mid-1990s. Again, curve marginally inverted, and the Fed immediately started to ease aggressively and caused the steepening. If the Fed throws caution to the wind and just starts easing aggressively here, sure, that changes the picture. But for right now, like I said, the curve's not just inverted, it's deeply inverted. It's been that way for a while. Those 2 times where you had that mid-cycle, slowdown via curve inversion, it was very marginal, barely went below zero, and it wasn't there for a very long period of time at all before the Fed started to move the narrative in the other direction. So I mean, those are, this time, could it be different? Sure, it could. I think that's what the market's trying to say right now. And like I said, we're not aggressively short. We'll wait for the pattern to show up and the break to happen before we would suggest that aggressive bearish view to actually execute on that. But for right now, it's something to watch very closely and be mindful of.
So what JP Morgan is basically saying is if you break under this purple line, that could set you up for new 2024 lows. And the easiest way to kind of show this is to just show what tends to happen during downside cycles. It doesn't tend to be just one move lower and then new all-time highs and a sustainable rally after that, right? Take a look back here, the end of 2023 from July through early November. You had one kind of fall here. You bounced up quite a bit. You consolidated for a little while. You fell again to a new low, bounced up, consolidated for a little bit, fell again, hit a new low, and then you started to really rally. With valuations as high as they are, being it is a late cycle economy, I would argue, that just means you're closer to a recession than not. You're closer to some kind of slowdown than not, given we've come off of years of impressive growth. I mean, if you do fail here, you start to fall to that 50-day moving average, break lower, that could be very problematic. Now, coming next week, you are going to get NVIDIA earnings. NVIDIA tends to move before earnings. It tends to move 5 to 10% before earnings. And then after earnings, it doesn't tend to move that much. So next week before NVIDIA reports earnings could actually be a little bit more exciting than after NVIDIA earnings. I think we kind of have a good understanding of what NVIDIA is going to tell us. AI demand is good. It's not crazy like it was, but it's still pretty good. Obviously, anything less than that's going to be really bad news. And NVIDIA is still trading it at very high prices overall, $927 per share. The stock is down 2% today, so maybe you're starting to see a little bit of that, pre-earnings sell-off like NVIDIA typically does. But the stock is still in the 900s, so there is still high expectations for NVIDIA. And if NVIDIA fails next week, that would obviously be hugely problematic for the markets. I'm not expecting NVIDIA is going to fail or wet the bed or anything like that, but still, that pre-earnings move that you typically see can likely move the markets quite a bit. And really, from this point on, there's not too many catalysts left for markets. We just got jobs numbers, we just got inflation numbers, we just got the Fed, we're through earnings season. It's really NVIDIA. You have durable goods orders next Friday, and then your next non-farms is going to be around the 7th of June, and then your CPI report's going to be June 12th. That is the next Fed meeting as well in over 3 weeks time from now. So it's going to be pretty interesting to see how markets react in this time frame. And really what we want to be watching for is economic strength or economic weakness. Right now, the problem is, to some extent, the markets are assigning a 0% chance of a recession within the next 12 months. Back in 2022, at one point, you had a 100% chance of a recession within 12 months. If we just go to 20%, likely not a big deal. Likely not a big deal at all. If we go to 50%, that's a bigger problem. And that's where you're looking at 20-30% downside from current levels. And all it really takes is a couple bad data points in which we really haven't got a lot of good data showing strength in the economy for a while now. But if the economy holds up and continues to do okay, if inflation pressures start to abate even more in the next coming months, like I think they will, we could be setting ourselves up for a very, very strong summer rally. Again, if the economy weakens too much and recession fears start to rise, that will be negative for equities. No matter what the inflation picture is doing, no matter what the Fed starts to say. The economy and a recession is always going to take more precedence over the Fed. That's why normally when the Fed cuts rates for the first time, stocks tend to sell off over 20%, about 23% to be specific, over the course of about 190 days. If you get a Fed rate cut because you're entering into a recession, then you tend to fall over 30% within about 250 days time. So keep this on your radar. Economy's weakening, but how much? And like JP Morgan said, if you fall under that 50-day moving average, that is not going to be great. Now, here on the day today, the CNN Fear and Greed Index is sitting at 64, which is in greed territory, getting pretty close again to extreme greed. Yesterday, you were only at 60, so definitely more optimism today out in markets than there was prior. Your latest AI investor sentiment survey shows something similar. Bulls are at 40.9%, neutral investors at 35.9%, and bearish investors at 23.3%. 10-year Treasury yields today are up about 4.5 basis points, which is surprising considering the CB leading economic index came in very negative today. 0.6% on a month-over-month basis is a very negative number. So that's interesting, kind of weird, not exactly sure what's going on there. GDP, as per the Atlanta Fed GDP Now tracker, is estimated at 3.6% for Q2. This was off of where you just were at about 4.2%. And the percent of stocks above their 50-day moving average is actually declining now here on the day by about 0.2%. So 0.2% of stocks out there are breaking under their 50-day moving average today. Not that many. Not a big deal. Overall, 60.46% of stocks are above that 50-day moving average. Overall, I agree with Tom Lee and Fundstrat in the sense of small cap, interest rate sensitive areas of our markets are where you want to be allocated. Now, keep in mind, Tom Lee has a S&P 500 price target of 5,200 for this year, and he still hasn't raised it. Currently, the S&P is at about 5,290, so closer to about 5,300. Still, he did not raise his S&P year-end price target just yet, and I do believe that's because, you know, he thinks small caps, interest rate sensitive stocks are going to outperform, and maybe the S&P is not going to continue to be the big outperformer that it has been over the past couple of years. Especially if there is some weakening out in the economy with cuts from the Fed. Again, not too much, but some weakening with cuts from the Fed, and that could set you up for a very strong summer rally. But in the near term, it's all going to be about NVIDIA earnings coming next week, and NVIDIA tends to move before earnings themselves, sometimes more than even the day after earnings. So keep that in mind. NVIDIA is down about 2% today, which could be kind of a leading indicator, if you will, to what NVIDIA might do before earnings coming next week. So let me know what you think about all of this information down below in the comments section. TLT is down almost 1% today. Oil is up about 1%, and the dollar is up about 0.1%. You guys have a fantastic rest of your day. Hit the like button as well as subscribe to the channel if you made it to the end of this video, and I will see you in the next one.